Everyone is watching NVIDIA. But the quiet story in the background is the race to build the factories of AI. By the end of this decade, data center investment could reach trillions of dollars worldwide, with AI-ready sites taking the biggest share. Some research now sees data center spending on track to pass $1 trillion per year by 2030, driven mainly by AI workloads. At the same time, big tech companies like Microsoft, Google, Amazon, and Oracle are raising their capital spending to build more AI data centers, even if it puts pressure on near-term profits. So the key question is simple. Who actually gets paid while this AI build-out is happening? In this video, we are going to look at 3 stocks tied directly to that build-out: IRES Energy, ticker IREN, Applied Digital, and Vertiv. We will talk about what they do, the new updates around their business, why their stocks move so much, and what I am watching over the next 2 to 4 years. This is not financial advice. It is one investor's view on the AI data center boom. Let's start with the big picture. AI workloads are hungry. They need massive compute, massive power, and serious cooling. Recent reports suggest that by 2030, global data centers may require several $1 trillion of capital spending to keep up with demand, with AI-optimized sites taking the majority of that. Another research firm now expects data center capital spending to grow at a double-digit rate each year and reach close to $1.6 trillion by 2030. At the same time, we see concrete moves. Oracle has lifted its data center spending plans to around $50 billion to chase AI customers. Google is on track for tens of billions of dollars in AI-related infrastructure spending. Private equity giants keep buying data center platforms because power and capacity are scarce. So we are clearly in a build-out phase. For investors, that often behaves more like a 2 to 4 year theme than a simple buy and hold for 20 years story. Companies that own sites, lease capacity, or sell power and cooling equipment can see strong demand while the build-out is happening. But 10 years from now, the picture is much less clear. We do not know how efficient future chips will be, how many sites may become overbuilt, or how tougher energy rules might cap growth. That is why the key question is, who gets paid during this build-out, and who might be at risk later if demand does not match all this new capacity? Here is our roadmap. First, IRES Energy, a former Bitcoin miner that is becoming a hyperscale AI data center partner with a huge new deal from Microsoft. Second, Applied Digital, a data center landlord with campuses fully contracted to big AI customers, including CoreWeave and at least one large investment-grade hyperscaler. Third, Vertiv, a picks and shovels supplier selling power systems and liquid cooling to many different data center operators. Then we will bring it all together and talk about risk and time horizon. Let's start with IRES Energy. I will call it IRES. IRES began as a Bitcoin mining company. They focused on sites with cheap and mostly renewable power. They built data centers in those regions, connected them to the grid, and used that power to run mining machines and earn Bitcoin. That was the first chapter. The second chapter is about AI. IRES is now turning those same strengths, land, power, and construction, into an AI data center platform. They are building large-scale sites designed from day one for AI and GPU workloads, with both air and liquid cooling. One example is their Childress site in Texas, which is planned as a 750-megawatt facility designed for high-performance AI compute, connected directly to the ERCOT grid. Across their portfolio, IRES has now secured multiple gigawatts of potential power for data centers, including a big hub in West Texas where a new grid connection pushes their capacity there toward almost 3 gigawatts. So the scale here is already in the multi-gigawatt range. The biggest recent update for IRES is the new deal with Microsoft. In November, Microsoft signed a $9.7 billion AI cloud contract with IRES. The agreement runs for 5 years. It includes a 20% prepayment up front, and it gives Microsoft access to advanced NVIDIA GPUs hosted in IRES data centers. To deliver this, IRES is buying billions of dollars of new GPUs and infrastructure from partners like Dell. This deal did 3 important things at once. Number 1, it validated IRES as a serious AI data center operator, not just a small Bitcoin miner. Number 2, it gave IRES multi-year revenue visibility tied to one of the strongest AI customers on the planet. Number 3, it changed how many investors see the stock. The story is now less about the Bitcoin cycle and more about power, construction, and long-term contracts. Some analysts have even said that this was the moment when Iris quietly stepped out of the miner bucket and into the AI hyperscale partner bucket. So where is Iris today in terms of scale? As of this year, Iris has around 660 megawatts of operational or partially commissioned data center capacity. They have also shipped thousands of NVIDIA GPUs to start building their AI cloud business, and they have secured grid connections that give them a path to several gigawatts of total capacity across the United States. But there are still risks. A lot of their recent revenue is still coming from Bitcoin mining, so short-term results are still sensitive to the Bitcoin price. They also face execution risk. They must build these huge sites on time, bring in enough GPUs, and deliver reliable service to a very demanding customer in Microsoft. And like every company in this space, Iris is spending a lot of money up front. Investors need to watch their debt, their cash, and how often they issue new shares. For Iris, I would watch 3 simple things. Number 1, the price of Bitcoin over time, because it still affects cash generation. Number 2, their AI deployment pace, how much capacity they bring online, and how smoothly the Microsoft deployment rolls out. Number 3, their balance sheet, debt levels, cash, and the mix of equity and prepayments funding the build-out. If all 3 line up well, Iris can have a lot of upside. If one of them cracks, the stock can move down fast. Let's start with Applied Digital. I will call it Applied. Applied is a data center landlord focused on AI and high-performance computing. Their job is to secure land and power, design and build purpose-built campuses, and then lease that capacity to big AI customers under long-term agreements. One of their key projects is the Polaris Forge 1 campus in North Dakota. Recently, Applied completed Phase 2 of the first building there. That brings energized capacity on that building to 100 megawatts. Polaris Forge 1 is part of a 400 megawatt deployment that is fully contracted to CoreWeave under long-term leases. So one building is already at 100 megawatts, and the wider campus is slated for 400 megawatts, all spoken for by a major AI cloud partner. Applied is not stopping at Polaris Forge 1. They are also developing a second campus, called Polaris Forge 2, in another part of North Dakota. For Polaris Forge 2, Applied is initially building around 300 megawatts of data center capacity. Out of that, they have already leased 200 megawatts to a US-based, investment-grade hyperscaler. That same customer also holds a first right of refusal on up to 800 more megawatts at that site. If that option is used, Polaris Forge 2 could scale up to 1 gigawatt of total capacity with a single anchor tenant. Between the CoreWeave deal at Polaris Forge 1 and the hyperscaler deal at Polaris Forge 2, Applied now has multi-billion-dollar lease commitments tied to its AI campuses. So this is not just a story of, we hope someone shows up. They already have large, contracted customers for much of their build-out. Why is Applied interesting, and what can go wrong? On the positive side, they have long-term leases with big AI customers. They are building campuses that could each reach gigawatt scale over the next few years. They benefit directly from the AI data center build-out, without having to mine Bitcoin or run their own AI services. On the risk side, there is customer concentration. CoreWeave and 1 or 2 hyperscalers are responsible for a large chunk of their future revenue. If those customers slow spending, delay projects, or change strategy, Applied will feel it quickly. The stock also has meaningful short interest, which can make price moves very sharp in both directions. Applied is therefore a pure play on AI data centers staying full and on its existing customers continuing to scale. Now let's talk about Vertiv. Vertiv does not own or run data centers. Instead, it sells the equipment that keeps data centers running. Vertiv supplies power systems, battery backup, critical switchgear, and cooling solutions for dense, high-power racks of servers. When a company builds a new AI-ready data center, it usually needs some combination of Vertiv's products: uninterruptible power supplies, thermal management systems, and now more and more liquid cooling gear for advanced AI workloads. The AI build-out is already showing up in Vertiv's numbers. Recently, Vertiv reported quarterly sales growth of around 29% year-over-year, driven by strong demand from the Americas and the Asia-Pacific region. For the full year, Vertiv has raised its guidance and now expects revenue of more than $10 billion, with organic growth in the high 20s in percent terms. Earnings per share are also set to grow sharply, and the company now expects around $1.5 billion of adjusted free cash flow for the year. Management has been very clear that AI data centers are a major driver of this growth, especially in the thermal and power product lines. One key angle for Vertiv is advanced cooling. AI GPUs run extremely hot, especially when you pack many of them together in a single rack. Old, air-only cooling systems were not designed for this kind of power density. Vertiv is one of the leaders in liquid cooling and other high-performance thermal solutions for AI workloads. Liquid cooling can move heat away from chips far more efficiently than air. This allows data centers to pack more compute into the same footprint without overheating. Another advantage for Vertiv is its broad customer base. Vertiv sells to big cloud providers, shared data center operators, telecom companies, large enterprises, and public sector clients. So Vertiv is less dependent on one or two big tenants, and more tied to overall data center spending across the industry. As long as AI data center build-out remains strong, Vertiv has a good chance to keep selling power and cooling gear into that wave. So how do these three names fit together? To me, they are three different ways to play the same main theme, the AI data center build-out over the next 2 to 4 years. Right now, capital is flowing into land, power, cooling, and GPUs on a massive scale. Iris Energy is a transition story from Bitcoin miner to AI data center partner, with a very large multi-year deal from Microsoft. Applied Digital is a campus landlord with gigawatt-scale ambitions, backed by long-term leases with CoreWeave and a major US hyperscaler. Vertiv is the picks and shovels supplier, selling power and cooling equipment into many different data center projects around the world. All three benefit from AI infrastructure spending, but they do it in different ways and with different levels of risk. Here is a simple way to think about each one. Iris Energy. High risk, high potential reward. You are betting on both Bitcoin and the AI pivot. The Microsoft deal is a huge positive, but execution and funding still matter a lot. Applied Digital. A pure AI data center landlord. Strong upside if AI tenants keep filling its campuses and if planned expansions toward gigawatt scale go well. But there is customer concentration risk and stock volatility from short interest and sentiment. Vertiv. A power and cooling supplier with many customers. Still tied to AI and data center capex, but with less single customer risk and with proven earnings growth backed by real orders and cash flow. None of these are safe, set it and forget it utilities. They live at the intersection of big technology shifts, large capital budgets, and changing expectations. Personally, I see them as active positions rather than forever stocks. If I own them, I would track data center spending, customer updates, and balance sheets carefully. Remember, nothing in this video is financial advice. It is for education and entertainment only. Always do your own research. Know your own risk tolerance. And never invest money you cannot afford to lose. Now I want to hear from you. Are you Team Iris, Team Applied, Team Vertiv, or are you avoiding AI infrastructure stocks altogether? Do you think we are in an AI infrastructure bubble, or is this just the first phase of a much longer build-out? Tell me in the comments. If this helped you understand the AI data center trade a bit better, please tap like. And if you want more deep dives on AI, infrastructure, and related stocks, consider subscribing so you do not miss the next one. Thanks for watching, and as always, happy investing.